Good morning, everybody. A very warm welcome to week 6 of Financial Fitness Fridays. My name's Darren Laverty. I'm your host for today. I do have a special guest I'll tell you about in a moment. Today's topic is estate planning, preserving family wealth for future generations. I work for Second Sight, the employee benefits division of Foster de Novo, and my role is a financial well-being strategist. What today's about, it's not about us selling our business to anybody. It's about giving you really useful content. So you can relax, rest assured, there's no pitching, there's no selling, there's no proposition, there's no product at the end of this. Okay, it's just pure financial well-being content. We've been taking feedback from you guys over the last few weeks and trying to make sure we steer this down the right road and actually address the topics which are most important to you. And we're going to do that again. So at the end of the session, when you log out of it, you'll be taken straight to a feedback questionnaire. We want your feedback, okay? We really do, because we want to fine-tune this for other people. We want to improve the experience. We want to make sure that we're going down the right road, and also that we're hitting the right spot, trying to get the positioning about right. We can't get too technical. We can't keep it too high level. It's trying to get that balance absolutely right. There was a question at the end of last week that was left open, and I think I've got the answer to that. The question last week, we were talking about property investment and mortgages, and one of the questions was on our help to buy equity loan. If the property was in negative equity, how is the government loan treated? And the information that we seem to have found out is called an equity loan. So it's a percentage of the property. So the government would get back their percentage of that property sale. Okay, that's as far as we can find out. If you're going to use that kind of scheme, though, make sure you get your advisor to confirm that in writing, just to be absolutely certain. So this is about financial well-being, and one of the big aspects of financial well-being is preserving family wealth. And our guest today, who I'm going to interview in about 5 minutes, is a chap called David Stockdale. David Stockdale is one of the most qualified people in this area in financial services that I know. He's qualified by an organisation called STEP, which is the Society for Trusts and Estate Planners. Okay, he's highly qualified in this area, and he's going to share his knowledge and his experience with you. And he's very engaging. He keeps things very simple, and he talks in plain English. I have a bunch of questions already set up to go through with him in this interview. We're going to end bang on the half an hour because we understand that some of you have other meetings to go to. That's fine. For those of you that can stay on for 10 or 15 more minutes, we're going to have an open forum, Q&A. You send in your questions through the chat function. I'll be asking Dave those questions. Dave can answer those, and we can go on for another 15 minutes. So it will end officially at the half-hour stage, but we will keep going for another 10 or 15 minutes, as long as those questions are relevant. And if the questions are very personal to you, we'll try and pick that up separately. But if the question is general and it can help the audience, then certainly we will endeavour to get David to answer those questions for you. So as I always talk about the fact that financial well-being is 80% psychology and 20% mechanics. And so we can't ignore that. Neither one of them works without the other. We've got to want to do things. We've got to have a big enough why to take action. And then we need to make sure we've got the right strategy. So those two things combined are so important. And I know that the way David works is very much in line with that. He really does get to the core of what matters to people. And it's partly the technicalities, but also it's about family. And so therefore Dave's going to touch on that, because at the end of the day, for most of us, that is the most important thing. Now, financial well-being, the official definition of financial well-being, there are 4 different pillars for this, and I'm just going to talk to you about one of them because it's very relevant for today. And one of those 4 pillars of financial well-being is to have solid economic foundations. We've got to build upon something solid. Now, there's 2 ways of looking at that solid foundations, and one is that it can be, physically, financially solid foundations. But also it needs to be psychological as well. So we need to feel good about things. We need to know, rest assured that everything's taken care of. So when we talk about solid economic foundations, that comes in 3 things, which I've talked about the first 2 quite a lot in previous sessions. Making sure you've got an emergency fund in case anything happens, to avoid going into high interest debt. The avoiding and having no high interest debt is another element. But the third element, which is where we're going to focus today, is family protection. And that comes in two things. One is that making sure that whatever happens, there's going to be enough money around for the family. That comes from protection, and you get a lot of that through work, through your employee benefits package, but you might need more and you might need to understand more. That's one element of it. The other element is to have some basic estate planning, okay? So, making wills, that sort of thing. So why is this so important? Well, what's happened in the last 20, 30, 40 years is that there was a generation of people that are kind of holding the wealth of the nation, and they are generally the baby boom generation, the people sort of over age 50. And the reason they've got the wealth is because they bought properties when they were very cheap. They got into the stock market because of all the privatization. Even some of their pensions moved to stock market type pensions rather than the old guaranteed ones from the yesteryear. And what happened was the stock market and the housing market just went up very rapidly during their lifetime when they were already in the market. And so it does bring with it a responsibility. Also, the offspring of those people are sometimes considered to be the first generation who might not be so well off as the previous one. And so it means that family wealth preservation has become so much more important nowadays, and inheritance tax is affecting many more families than it was designed to do. And also there's lots of divorces and families splitting up is affecting where the money goes. So that's the kind of, and I think from a financial well-being perspective, it's really important. You imagine that, your family wealth gets eroded, the money goes to the wrong family, or it gets paid out unnecessarily in tax just because there was not some forward planning taken care of beforehand. So that's kind of the setting the scene, what it's all about. As you know, I always focus on the financial well-being aspect, and there'd be nothing worse than seeing tens or hundreds of thousands of pounds of your family's wealth disappear. That is not good for financial well-being. So without further ado, I would like to introduce our guest, David Stockdale. David, are you there, mate? Brilliant. Hi there. Good morning. How are you?
Yeah, I'm good, Darren. How are you?
Yeah, fine. Thanks ever so much for jumping on today. Really appreciate, you're a busy man at the moment. I have a bunch of questions for you, and I've got lots of people from previous sessions have sent in their requests. So I'm going to just sort of kick that off really, because this is a big subject, and I don't even think, in the sort of next 20 minutes or so that we've got, we're really going to do it justice. So I'm just going to kick straight off though with it, and that is, from your perspective, in plain English, David, what is estate planning?
Well, I think the best way of describing it is that if someone passes away, they leave something behind, and that will be possibly property, investments, personal belongings, pensions, and that is an individual's estate. And the planning is all about what you can do before you die to ensure that, one, that money passes to the people you want it to pass to, and secondly, it's done in the most tax effective way.
Brilliant. Okay. And so why is it so important nowadays then, compared to maybe 20, 30 years ago?
I think the point you made earlier was very relevant, is that a lot of people, certainly people who are 45 plus, are sitting on a lot more wealth than than previous generations. And therefore more and more people are caught by inheritance tax, and therefore more and more people are paying taxes than ever before. And secondly, as you said before, a traditional, 2.2 kids family that lives throughout their life with no complications is quite rare. The amount of divorces in the UK is greater than ever before. The number of people who have step children or step sisters is higher than ever before. And when you have family breakups, it brings added complications. And therefore, if you don't put the right planning in place, and we see it all the time, what often happens is money, in effect, can potentially go to the wrong people.
Brilliant. Okay. And so I think there's for a lot of people, we know that the majority of UK adults just simply haven't even made a will. What do you think are the reasons for that, Dave? Why do you think people don't get round to making a will? Why should they?
Well, I agree with you. We've seen statistics recently that suggest that over 50% of the UK population does not have a will, which is concerning. I think the reason people don't do it is because you're trying to address something that is to deal with when you die, which isn't a particularly pleasant subject. It's not something that's high on people's priority list to get up on a Wednesday morning and go, I must go and sort this out. And a lot of people defer it. And it's basically all kinds of people, Darren, of all ages and all wealths. So the number of people that don't have a will is alarmingly high. I think it's a degree of apathy. And also it's one of those things that you put down on your list that I must go and do. I think also there's a dilemma about what they should do. Do they go and see a professional lawyer? Do they use a will writing service? You can get it from certain retailers. You certainly can get it online. And so I think there's a little bit of confusion of what to do, a degree of apathy. And to your point, is it important? It's vitally important, because if you die without a will, you die intestate, it basically means it takes a lot longer for the money to pass down to the people you want it to pass down to. And as I mentioned earlier, there's a very good chance it potentially will go to the wrong people.
So when you say die intestate, what does that mean in plain English?
All it means, you died without a will in place. So when somebody comes to assess your estate, they will say, well, what was this particular individual's request? And the response is there isn't one. And so it therefore will follow the states of the law in the way that money is distributed, as opposed to reflecting the wishes of the individual.
So if there was a married couple, for example, and there was no will in place, and you used the laws of intestacy, how would the estate be divided up?
Well, what happens now is that, you know, if there is a couple with no children, to be honest, it's reasonably straightforward, because the first 275,000 passes directly to one spouse, and then a 50% interest in the remainder of the money, but a portion of the money can go directly to the children. And the problem with that will be is that there is no inheritance tax between a husband and wife, but there is a potential liability for tax if the money goes to children. So if there was no will and there was a married couple with children, you could end up in a situation where inheritance tax is due, when it could have been avoided if there was a will in place.
Yeah, and I hear something, I don't know all the detail, I'm sure you can clarify it, but I understand that some people made a will in the past, but they absolutely need to review it right now because something changed. What was it that's happened? Why are some of those wills now not relevant?
I mean, one point that was brought in was something called the residential nil rate band, which was an additional allowance that was brought in for people who hold property. Now, this goes back to the fact that the inheritance tax limit in the UK for an individual is 325,000. There has been for over a decade. It's never been inflation linked, which really means that over time, the amount of estate that potentially can get taxed is becoming greater. Something that I think it was the Conservative government discussed a number of years ago was increasing the nil rate band, and they decided to do it, but they did it in a complicated way, and they basically provided an additional allowance of up to 175,000 per person if you own your own property. And because that added complexity, a lot of historic wills have no reference to this, and with the right kind of planning, that can be utilised to the individual's advantage.
Right. Okay. Thanks for that. So, and I think people get put off with writing wills because, firstly, if they don't quite see that it's important enough today, I think another potential obstacle is the cost of it. So, how can people go about it in an affordable way?
Well, I think there's a couple of options. There are a number of will writing services that are available. They're available online. They're available through various companies, employers, in fact. And there are a number of businesses that do that. You know, you could probably set up a straightforward will, Darren, for probably £250 per individual. And I think it's better to do that than do nothing at all. The other alternative is to go and see a solicitor, a high street solicitor, your own solicitor. If your affairs are more complicated, it may warrant going to see a specialist, just because you may need to take some additional advice in regards to your estate, if that was the case. So,
what when you say that, what is a specialist? What you're referring to there?
Well, I think you would go. I think that you could go and see a step qualified either financial planner or lawyer, and the reason for that is that the majority of wills that we see are relatively simple and straightforward. They simply pass money to husband and wife and down to children, And in a lot of cases, I think that probably will suffice. I think that as the value of the estate gets greater or the family situation is more complicated, thought should be given to taking special advice, because there will be certain elements of planning could be put in place that could be more protective.
Okay, thanks. And when I hear the word will, I always often hear that in conjunction with the word trust. So it sounds complicated, but you know, from your perspective, again, in plain English, what is a trust, and why should people consider them?
Yeah, I don't know if you can show, if you're able to show slide 7, Darren, but I think the way to think about this is that there are 3, if you like, entities that exist in the UK from a tax perspective, and that is a self-employed person, a limited company, or a trust.
Slide, is it, hang on, let's just get the right slide up. Is this one?
Yeah, that's it. Yeah.
Okay, brilliant.
And so an individual is an entity, a limited company is an entity, and a trust is an entity. So nearly everything and anything will form one of those fall into those 3 categories. The reason a trust is sometimes used is that it gives greater certainty than a simple will. And as you say, although trusts are considered to be relatively complicated, in principle, they're quite straightforward. There are 3 elements to a trust. The first part, for every trust, there needs to be what's called a settler, which is the person who settles it. He's the person or the persons who gifts the asset away. The second party involved is a trustee. A trustee is somebody, it can be an organisation or it can be an individual that holds the assets on behalf of the third party, which is the beneficiary. And the beneficiary is the parties that will ultimately benefit. So by way of an example, if you had a situation where you had a married couple who had a property and various assets, they might say that when they die, they would like their wealth to pass to their children, and their children, as it happens, are only 13 and 14 at the moment. They don't want the situation where all of that money goes directly to their children at the wrong age. And so what they put in place is a trust, and they may have appointed, you know, the settlor's respective brother and sister, people that they trust, to act on their behalf. So if the settlors died, the wealth would pass down into a trust, which for the purpose of the explanation could simply be a bank account. The trustees, the brother and sister, would be there to ensure that that wealth cascades down to their children at a time that the settlers have agreed, and at a speed and in a way agreed by the settlers.
So that is the benefit there is that the children are not getting the money too young when they're not mature enough to handle it. What are some of the other benefits of having a trust in place?
Yes, I think the first one is the control at when they could access the money. The second thing for a lot of people they consider is that, as I've mentioned before, if you took the example where there was no, let's take the example of the husband and wife, and let's say the wife has died first. If there's no trust in place, the husband theoretically could remarry, and the money that was destined for the children would never go down to the children. That is one risk. If you had a situation where the husband and wife have both died and the money goes down to the children, and the children, let's say, got married but then had separations or divorces, you know, the wealth from the parents could theoretically cascade sideways. So not everyone, but certain people consider it their responsibility to ensure that their wealth stays within the family unit. And the reason a lot of people use family trusts is it gives more certainty that will be the case than if a simple will or no will was in place.
Brilliant. Okay. Now we also hear about inheritance tax, you know, and obviously tax is a very hot topic, but what is it and who has to pay it?
So yeah, it is a hot topic, and if you went to slide 5, that might be helpful, Darren.
Okay.
So inheritance tax is liable when somebody dies and the estate that they leave behind is over £325,000.
That one there.
Yeah, so what this really shows you here is a couple of examples. So if you had an individual who is single, they passed away, they own a property worth £300,000 and nothing else, then because their estate is less than 325,000, there would be no tax to due. In scenario 3, we have a situation where someone has an individual has £1 million estate, and the first 325,000 is tax-free, but the remainder is potentially taxed at 40%. So in scenario 3, the amount of tax due is 270,000, and it just keeps increasing. So going back to your point earlier, for people who've been fortunate enough to build up wealth through property and other assets, the amount of inheritance tax could be quite significant. As I mentioned, there is no inheritance tax between husband and wife, irrelevant of the value of the estate, but there is potentially inheritance tax when the money cascades to other family members.
So somebody's earned their income and they paid tax on their income. They've then maybe invested money and paid capital gains tax on investments. And then are you saying then that above 325,000, whatever's left is taxed again at 40%?
Yeah, that's exactly what I'm saying. So you're right. We've often viewed it, and the fact is that, somebody's wealth can diminish very significantly during their lifetime because, one, they're paying income tax, which is understandable and fair enough. If you've made investments that have done very well, you potentially could pay capital gains tax. And as you say, without any planning in place, there theoretically could be an additional 40% inheritance tax on those exact same assets when you die.
And here's a question then, David. So let's imagine that the inheritance came in property and there's an inheritance tax bill due. We've got a bit of a chicken and egg situation. How do we physically pay the money from a property that's not?
Yeah, in those situations, it is a difficult situation because HMRC are not particularly lenient on that fact, and they want their money. So often what happens is the individual who has received the property needs to sell it pretty sharpish, or raise some money from other sources, or if there was other monies in the estate, use those to pay the inheritance tax.
Wow.
And as you mentioned earlier on, if you look in the southeast of England, there is a significant amount of properties that are over the inheritance tax limit, clearly, and therefore the number of people that are paying inheritance tax is increasing. I think it's over 5% of all estates are now paying inheritance tax.
Wow. So from a normal family situation, it wouldn't be difficult to appreciate that a lot of families are going to get caught up with this because the value of property has gone stratospheric in the last 2 decades, for example, and so the 325,000 is going to be breached quite quickly with just a property. So it's affecting ordinary people, not just rich people, which is worrying. What are some of the best ways for families to tackle inheritance tax?
Well, there are a number of courses of action that can be taken. I think ultimately, if one gets into a situation where they consider that they've got enough money for the rest of their lives, and this is the difficult thing, Darren, for a lot of people, they are trying to work out how do they do the planning, but they don't know how long they're going to live. And so what you can't do is start putting things in place that in effect negatively affects you as an individual throughout your life. So if you were fortunate enough to be in a situation where you could say, I know I've got enough money for the rest of my life, the 2 things you can do is spend more money and enjoy it, or start gifting it away. And if you gift money away, the rules are there is no tax or no implications on giving money to anybody, family member or anybody else, as long as you live 7 years. If you die within that 7-year period, some of that money is brought back into your estate. So spending the money or gifting it is one option. There are a couple of other options. One of them is you can actually insure against it. So some people choose to buy insurance that will pay the inheritance tax bill. And there are certain products that you can invest in that are very tax effective. And the final point we talked about earlier, some elements of the trust planning I mentioned can be very, very tax effective and can mitigate some of the inheritance taxes that might be due.
Fantastic. So I have a question here that's come in, and I'm going to ask the question, even though it's not at the half-hour stage yet, because I think there's a simple thing that some people can do to actually preserve some of their family wealth. The question is, are ISAs and pensions exempt from inheritance tax?
ISAs are not. pensions are, the way a pension works, such as a personal pension as an example, is that in the event of a member dying or an individual dying, that money will in effect pay potentially to a particular beneficiary, and there is no inheritance tax when that money passes from the person who has died to that individual. One thing that I would say that a lot of people don't realize is that if your beneficiary is your spouse and you transfer a pension fund to your spouse, there's no inheritance tax between husband and wife anyway. And what then happens is that money that belongs to that individual now sits with the spouse. And if it's being paid directly to the spouse, when the spouse ultimately dies, there potentially could be inheritance tax on that money. So that's something that we think a lot of people aren't aware of and possibly should be.
Okay, we're nearly out of time, but I just want to get one point out there for people, because I think this is something which is a quick win for a lot of people. And that is they have, most people on this session today are employed, working in a company where they probably get some death in service, and they will also get a pension scheme from work. And there are some simple ways they can protect that.
Yeah, there are. I mean, I think that we talked about it a little bit earlier, but there is something it's either called an asset preservation trust or a pilot trust, and that is a simple trust arrangement that can be set up. And what an individual does is chooses to bequeath their death in service and their pension fund into the trust I've just mentioned, and that would deal with the problem we just talked about, Darren.
So practically then, I mean, I think those particular trusts, if it's simple enough, can actually be built into a will. Is that correct?
Yeah, you can include them, and most lawyers, I think, and most solicitors would mention this to you if you were having that discussion with them. Not all, but I think most would be. So you're right, you can incorporate that through a certain mechanism.
And then we have a trust mechanism set up within a will or separately for this particular job. And then my understanding is that what people will then have to do is to go to their death benefit nominations for their pension and the death in service and change that to the trust. Is that the way it goes?
Yeah, so if you have a pension or a death in service, you would have been requested to fill in a nominated beneficiary form, which says where that money should go. And in the example you gave, let's say you've said it's my husband, you will then change it to say it's my trust.
Brilliant. Thanks very much, Dave. Okay, look, so we've run out of time. I'm going to obviously stay on for those people that want to stay on for Q&A, and there's been lots of questions coming, Dave, so we're going to use the whole 15 minutes up. I just want to get to the final slide and talk about next week. If you have to go now, then feel free to go. We're not offended, because it is a half an hour slot, but please, could you make sure that you do the feedback form for us? We want to make sure we're hitting the spot for you guys, making sure that you find out everything you want to find out. We need to know what you liked and what you didn't like about the experience, and then we can fine tune that for future events. Next week, I have another wonderful special guest advisor being brought in, a lovely lady called Sharon. And what we're going to be talking about is the 5 financial planning opportunities in a crisis. So make sure you're tuning for that one. I also have to put this caveat up, because we are a regulated entity. Even though we are not promoting our own company, we do have to put this one up. So thanks for everyone for joining in. Those that are still on here, which is the vast majority of you, which is normally the case, we're going to go to questions. So I'm going to stop the share for a moment. I'm going to look at some of the questions. Okay, so let's have a look. Okay, if you don't currently have children, but plan to do so in the future, would you recommend making a will now and then reviewing it once you have children, or waiting until you have children to make one? And how often would you recommend reviewing it?
Yeah, so I think my recommendation would be, even if you're single and just starting out, you can get a very, very low cost will. I think it's just good practice to get one up and running straight away. Regarding reviewing it, the idea is to review your will when your circumstances change. So a good example would be, as per the question, you had children, your financial situation changed quite significantly, you got divorced, you got separated, or you got married. You can do something called a codicil, which is basically an amendment to a will. So it's not always a case of rewriting a will, it's making an adjustment. But I would suggest yes, if you're a couple or married, then doing a will now would be a good idea.
Brilliant. Another good question here. Just to clarify, I think we all know the answer, but just clarify it from you as the expert, Dave. Is there no inheritance tax on an estate left to someone from their partner where they've had a civil partnership rather than a marriage?
Yeah, so the rules on civil partnership work exactly the same as for marriage now. If you're in a civil partnership, you're covered. If you're in a relationship and you're not married, you are not covered. In law, you're just two individuals. And obviously there are plenty of people, as we know, that live together. And that is one of the challenges that a lot of people are finding. We see it quite a lot with young people who are buying properties together and they're not married. And we would very much advocate the setting up of a will in those situations to make sure there's no ambiguity about what should happen if the couple split up or one of them dies.
Thanks, brilliant. Another good question here. I think this is also, there's a lot of confusion around this particular thing, and that's gifting property or gifting assets. So the question is, can I gift my property to my children now? And if I die after 7 years, there is no inheritance tax. Is that correct?
Yes, assuming it's not your own property. If it's a asset, so it's not your own residence that you're living in, you can gift it, and the rules apply, as I mentioned before. You can gift whatever you wish. There's no tax on a gift, and if you've lived 7 years, you would avoid tax. If the question was regarding a residential property, which a lot of people do ask about, it's more complicated. What happens there is that if you are still living in the property, it's treated as a gift with reservation, and therefore will potentially be caught by those rules. And the only way around it is the fact is that you demonstrate you've given the property absolute, and you now are a sitting tenant within that property and paying full commercial rent, and that it very much has become your children's asset, and you are simply a tenant and you're paying them for living there. And if you did that, theoretically, HMRC would expect to accept it.
Okay, it's never straightforward, is it?
No.
I've got a really good question here. I'm glad this question's come up, actually. David mentioned one way of planning for the repayment of inheritance tax is to take out a life assurance policy that pays out the estimated tax bill on death. So they're quite, Lizzie, she's quite interested to know what's your view on this approach, and is it worth the significant monthly payments for the cover?
So my view on it is that what often people conclude is when they do the full analysis and work out what the premium is going to be and what the likely payout is going to be, it's almost too good to be true, in as much as that although the premium might seem high, when you do the calculation and work out that, let's say, even if you lived to 100, you would have paid a lot less than the sum assured, it seems like such a good idea. But the reality is, why do insurance companies do this? And the reason insurance companies do this and are able to do it is that very few people keep their policies going throughout their life. People cancel plans early, which creates profits for the insurance company. So my view is that as an actual tool for paying inheritance tax, it is quite a canny method. I would warn you about a couple of things. First of all, it can only work if you take out what's called a whole of life plan, which is guaranteed to pay out and last for the whole of your life. Do not take out a term assurance, because that could stop before you die and it would have been a waste of money. And secondly, you need to be absolutely convinced that you can continue to pay that premium throughout your life. And, you know, who knows how long we'll all live, and, you know, what our mental state will be and our ability to remember to make payments, and is it automated? But to answer the question, I think as a mechanism, compared to a lot of other things, it is a very, very straightforward. And I think for certain clients, it does make a lot of sense to seriously consider this, certainly for part of the inheritance tax.
And what about the offspring? Could they be responsible for the monthly premiums, because it's the ones who are going to benefit from the full inheritance? Yeah,
that's a good point, and we do see that quite regularly with certain clients, that if we're advising a family, or a family's being advised in totality, and this matter is being brought up, you're absolutely right. The inheritance tax ultimately sits with the responsibility of the offspring or the children, and they may well be in the position to and motivated to make the payments. We've seen it a number of times when people have passed and the insurance policy is paid out. And in fact, in all cases we've ever seen that, people look back and going, that was a really prudent piece of planning to put in place.
Okay, thanks a lot, Dave. So another thing that comes out a lot in conversation with people and is a bit misunderstood is gifting. We've talked about gifting, into a trust, but just literally gifting money, parents to children. How much and how often can they gift and not fall foul of breaching any inheritance tax thresholds?
Well, there's a couple of rules. First of all, there are various allowances that one can follow. Approximately, it's £3,000 per individual. So you had a mum and dad, and they could give £3,000 each. It's not per child; it's per donor. So the husband and wife could give £3,000 every year to anybody, and that doesn't get caught by any rules. You can give certain gifts for weddings and grandchildren and the like. And there is another interesting rule, Darren, that says you can give any amount of money on an annual basis as long as it's out of your regular income, and that also is not caught. So you can give any of those amounts and they are simply not treated or caught by any rule. Any other amount can be made, and it could be £1 or £1 million. There is no tax implication on giving it. However, as mentioned before, there is a 7-year rule. So if you die within 7 years of making the gift, a portion of that money comes back into your estate and is taxed accordingly.
Brilliant. Okay. Another good question, I think, up here. This one's from Chris. He said, if you have a property worth £1 million, but you have a £750,000 mortgage on that property, is he right in assuming that there's no inheritance tax because what's going to be passed on is effectively £250,000?
Yeah, that's correct. It's the net amount. So you look at the value of the asset, obviously on death, assuming the property was sold, the mortgage would be cleared, and therefore the net proceeds in that example would only be £250,000.
Okay, another question. Can I gift my property to my children and still carry on receiving a rental income?
You can. That's quite complicated, and you'd need to include a trust structure. Otherwise, as I said before, it's treated as a gift with reservation. So HMRC will say, we haven't really given that away. You're still enjoying the benefit of it, and therefore we challenge it. There are certain structures that exist where you can, in effect, give away the capital, but continue to be able to benefit from the income. But going back to that gift of reservation, it has to be done at arm's length. So theoretically, the children could stop paying you the income, sell the property. If they couldn't do that, it would be treated as not acceptable. So I think if you spoke to a decent lawyer, they will be able to advise on how you do that.
Right, brilliant. Okay, just a little simple question here, I think, but let's clear it up. The question is, can you have several life insurance policies and could they all pay out?
There's no limit to how many life insurance policies you have, and you can have as many as you'd like with as many providers as you'd like.
And is it worth just mentioning about life insurance policies and trusts for a moment while we're here?
Yeah, I think that there's two parts to this. One of them is that if you have a life insurance policy, it's a little bit like the death in service. And the fact is that if you die, it will pay out into your estate unless you say something different. So what's quite surprising is that most life insurance policies are not set up on a trust structure, and they should be. And the reason they should be is that money will then be kept outside the estate if it's set up correctly. You can organise trusts through the insurance company that you've set your policy up with, and it's good practice to consider that. Or you can use more bespoke trust structures through financial planners or solicitors. And then going back to the inheritance tax product we talked about earlier, if you set up what invariably is called a second death policy, because it pays out when the second of the husband or wife dies, because that's when the inheritance tax is due, clearly that needs to be paid into trust, because otherwise that will go into the estate and negate the benefit of doing it in the first place.
Okay, so just want to clarify a point there. So you mentioned that life insurance policies can be set up with the trust structure, that the trust can be obtained, or the paper can be obtained and set up via the insurance company.
That's correct.
How much does that cost?
That doesn't cost anything, because if you set it up through the insurance company, there's no fee. So the insurance company, it is best practice for them now to give guidance on this, but historically that wasn't the case. So nearly all insurance companies would give you the capability of writing the policy in trust if you so wished.
And if it was free, then why did that piece of work not happen then in the past, historically, would you say?
Well, I think it's not obligatory for the insurance company to insist on it. Also, financial advisors, possibly in the past, maybe weren't so focused on it. A lot of people buy their insurance companies directly on the internet and the like. It's not something that is a requirement. So I think it's probably a bunch of those reasons. I think nowadays, if people were buying a policy from a financial planner, there would be an obligation for that subject to be discussed.
Okay, I'm going to ask you one more question, and then I'm going to wrap up with 2 actions that people need to take. So, quick question is: do children inherit your mortgage debt when you die?
I think what will happen is that the asset. I think. Thinking my feet a bit, Darren, but I think that there would be an obligation for the mortgage debt to be cleared on the death of the individual, so that there would be in the settling of the estate, there would be a requirement for that debt to be cleared off, and if not, there could be a negotiation with the lender for the point that's been asked there to occur.
Yeah, right. Okay, so just to wrap up, because we're now coming to the end of the 15 minutes. So David, just if there was 2 actions that you could suggest to people that they take or consider taking right now after this session, what would those 2 things be?
So I think the first thing would be, if you do not have a will, or have a will that has been set up over 3 or 4 years ago, I think you should go and speak to somebody and have it reviewed. And as I mentioned, I think you can go and speak to a will writing service, a high street solicitor, or a specialist. And I think for those of you that have sort of built up a degree of wealth, or have any complication in your family life, I think it's important to start thinking about what you would want to have happen if anything happened to you, and then ask yourself the question, well, have I put the right kind of planning in place to make sure that happens? And if the answer is not, put it on your wish list of things to do, and make a point of having necessary conversations about it.
Brilliant. Okay. And so somebody who did have a complicated situation and did want to find a STEP qualified financial planner, where could they find one?
Yeah, I think if you use somebody like Unbiased, and there are a few other specialist sites, if you like, that will direct you to, and I think if it was complicated, you need to find a STEP qualified financial planner and or solicitor.
And does STEP themselves, do they have a directory that people could access? Do you know?
Do you know what, Darren? I don't know the answer to that.
No. Okay, you can't know everything, Dave.
No.
Listen, thank you so much. Really appreciate your time. I'm sorry to put you on the spot there. The last 15 minutes can be quite stressful for my guests, I know that, but you've done a sterling job. Really appreciate it. Thanks ever so much. Really, really good stuff. So guys, those that are still here, look forward to seeing most of you next week. Next week, 5 financial planning opportunities in a crisis with a lovely financial advisor called Sharon. So look forward to seeing you then. Have a great weekend. Take care and bye for now. And don't forget to do your feedback. Okay, take